Well, the recent rally in the global equity markets can be attributed to two common factors. One, the liquidity, and of course, India has seen a gush of liquidity come into the Indian equities. You have the foreign investors that have pumped in nearly $5 billion so far this year itself, making it the only Asian country to have received inflows from foreign investors. And the other one is, of course, how the dollar movement has happened. The dollar index has, come off from its 52-week high that it had hit earlier this year itself, more than 102, 103 levels that it had scaled past, and currently trading very close to the 93 level. Which means that it has had a significant 10 to 11% pullback or drawdown that we have seen for this year itself. And in the process, it has managed to scale below its 200, 100 as well as 50-day moving average. So all the short-term and the long-term moving averages are currently above the spot price as well. However, in the last couple of months, what we have observed is that the dollar index has stabilized near the 92 to 93 or 94 levels, and the relative strength index, an important indicator which shows whether a security is in overbought or oversold condition as per the reading as well, currently suggests that it had become oversold because the reading had dipped below 30. However, interestingly, what has happened now is that the dollar index has made lower low pattern, which is from 94 to 93 to 92. However, on the other side, the RSI index that has made a higher high pattern, which indicates that this is a bullish divergence that we have had for the dollar index on the RSI chart. So essentially, it means that the dollar index could have bottomed out for the near term and is ripe for a bounce back or some technical pullback of sorts to higher levels as well, which of course could mean that the emerging markets would not like that too much. But there have been past instances where we have had the dollar index correct by more than 10%, and the subsequent reaction in emerging markets has not been great. Let me just map out those for you as well in history. In the last 10 years, we've had three instances of more than 10% drawdown for the dollar index as well, starting off with May 2011, when the dollar index had a max drawdown of 18%, and the MSCI emerging market index corrected about 8% over the next 3 months and 14% over the next 1 year. Then there was another instance in May 2014 when the dollar index corrected about 11% from its peak. However, the resultant reaction in the next 3 month and 1 year for the emerging markets was positive. There was a 4% gain over the next 3 months and about a 2.5% gain for the emerging market index over the next 1 year. But if you have a look at the third instance, 2018 February that I'm referring to, the dollar index corrected 15% from its top, and the emerging market index over the next 3 months resulted in a decline of 4%, and over the next 1 year it resulted in a decline of 14%. So essentially, there are two things over here, that the dollar index seems to have bottomed out and is showing signs of some pullback or reversal on the charts, and that would of course mean negative for the emerging markets, and the proof is in the pudding.